The Corporate Transparency Act, FRES. The 2026 Real Estate Reporting Rule: 2 laws, 2 moments, 2 different reporting triggers. By this point, you understand that beneficial ownership information must be collected in certain residential real estate transactions beginning March 1, 2026. However, in Arizona's investor-heavy market, you will frequently hear this statement at the closing table. I already filed under the Corporate Transparency Act. That statement may be accurate, but it does not automatically eliminate reporting obligations under the 2026 Real Estate Reporting Rule. These are 2 separate federal laws. They operate at 2 different moments. They are triggered by 2 different events. Understanding this distinction prevents confusion and protects your credibility as a professional. The Corporate Transparency Act, CTA. The Corporate Transparency Act, codified at 31 U.S.C., paragraph 5336, became effective in 2024. It requires many newly formed and existing entities, including LLCs and corporations, to file beneficial ownership information directly with FinCEN. The CTA applies at the time of entity formation. It also applies when certain ownership updates occur, or when control of the entity changes. Its purpose is structural transparency. The federal government wants to know who is behind business entities operating in the United States. Importantly, the CTA applies even if the entity never purchases real estate. It is tied to the existence of the entity itself. Formation is the trigger. The 2026 Real Estate Reporting Rule. The 2026 rule operates at a different moment. It is transaction-based, not formation-based. It applies at the closing of certain residential real estate transactions when 3 elements are present: covered residential property, purchase by a legal entity, and absence of federally regulated institutional mortgage financing. Even if an LLC properly filed beneficial ownership information under the CTA in 2024 or 2025, a separate real estate report may still be required at closing in 2026. This is not duplication. It is layered oversight. Why 2 reporting layers exist? The CTA focuses on transparency at entity formation. The 2026 rule focuses on transparency at the moment residential real estate is acquired, a transaction category federal regulators consider high risk for illicit finance. Knowing who formed an LLC is not enough. Ownership interests change, members are added, control shifts. Transaction-level reporting ensures the federal government has visibility into who owns or controls the entity at the time of the property purchase and how that transaction is financed. Formation transparency answers one question. Transaction transparency answers another. Arizona investor examples. Consider this first example. An Arizona investor forms Valley Rentals LLC in 2024 and files beneficial ownership information under the CTA. In 2026, that LLC purchases a Phoenix property with cash. The prior CTA filing does not eliminate the potential need for transaction-level reporting at closing. The 2 obligations arise at different stages. Now consider a second example. An investor formed an LLC in 2023 and failed to file beneficial ownership information under the CTA. That violation is separate from whether the 2026 residential real estate transaction triggers reporting. Agents are not responsible for enforcing the Corporate Transparency Act. However, confusion between formation-based reporting and transaction-based reporting is common. Common client misconceptions. Arizona investors may say, "I already disclosed that information." They may argue, "This is double reporting," or "They already know who I am." Some may believe it is a mistake. Your role is not to debate federal policy. Your role is to provide calm, accurate clarification. A professional response is, the Corporate Transparency Act applies at entity formation. The 2026 rule applies to certain residential real estate transactions. The settlement agent will determine what reporting is required for this closing. Neutral, factual, compliant. Avoid legal interpretation. Avoid personal opinions about federal policy. Stay within your lane. Arizona broker responsibility, under AAC. R4281101, licensees must exercise competence and reasonable skill. In an investor-heavy state like Arizona, understanding the difference between CTA formation reporting and transaction-based reporting is part of professional competence. Under AAC R4281103, designated brokers must supervise their agents and ensure they are educated about material regulatory changes that impact transactions. Brokers are not federal compliance officers. They are not responsible for filing federal reports. However, ignorance of major regulatory frameworks affecting common transaction structures is not consistent with reasonable supervision. Awareness and coordination are the standard. Public record vs. non-public federal databases. Another important clarification for clients concerns privacy. Neither Corporate Transparency Act filings nor real estate reports are recorded with the county recorder. They are not MLS data. They are not deed disclosures. They are not searchable public databases. They are submitted to FinCEN's secure federal systems. Transparency does not equal public exposure. That distinction often reduces resistance. Why this matters in Arizona's investor culture. Arizona's market includes high short-term rental activity, frequent LLC structuring, portfolio investors, out-of-state owners, and private money transactions. Many of these clients are sophisticated and will ask detailed regulatory questions. Your credibility increases when you can calmly explain. One law applies when forming the entity, and another may apply when purchasing certain residential property without institutional financing. Clarity builds trust. Transition to Section 3.4. You now understand the distinction between formation reporting under the Corporate Transparency Act and transaction-based reporting under the 2026 Real Estate Reporting Rule. The next challenge is practical rather than legal. How do you handle client resistance, privacy concerns, and uncomfortable transparency conversations in real time? Section 3.4 will focus on professional communication strategies and brokerage policy considerations.